Welcome to the Ultimate Beginner's Guide to Candlesticks. In this course, you will have free access to an extremely comprehensive collection of information about candlesticks and their practical use in trading. Unlike other courses you'll find on the subject, you will also learn the bad side of candlesticks and what you can do about it. In other words, the goal of this course is to provide an unbiased and detailed understanding of candlesticks. Before we move on, you should understand that this material is made for educational purposes only. Let's briefly go over the course content so you can have an idea of what to expect. We begin with the reasons why traders should care about learning candlesticks. This is important to know as it will keep you focused and motivated to go through all the comprehensive material ahead of you. Next, we move on to a brief outline of the historical context in which candlesticks emerged. There are a few important lessons to learn here, as you'll see. After this introduction, we'll talk about the candlestick itself from the ground up. You will learn price action quantization, the basic elements of candles, the fractal quality of candles, the composite candles, and time frames. With a clear understanding of how candles work, we'll study other charting methods that came from Japanese technical analysis. We'll briefly study how the Renko, line break, Kagi, and Heikin-Ashi charts are created and some basic setups of each. After this brief tangent to other types of charting methods, we'll return to the candlestick and the idea of why we should focus on it first. After that, we'll begin the most comprehensive part of the course, which is the outline of all the classic candlestick patterns. You will learn the function, the identification, the logic, and how to trade each of the candlestick patterns available. After that, we move on to the advantages and disadvantages of candlesticks and the most frequently asked questions to finish the course. You will also learn what the next steps are in order to truly master one of the most popular trading techniques, which also happens to be the foundation of price action reading. All of this material I just described is completely free. If you're new to the channel, please consider liking the video, subscribing to the channel, and sharing the video so that more people can have access to this guide. Why should traders care about candlesticks? For you to be motivated enough to go through the course, I want to provide you with some pieces of information that will make clear why traders should care about candlesticks. The financial market basically generates two types of information: price and volume. Price being the most important of the two by far. All the methods and strategies contained in technical analysis are either based on price, volume, or both. For example, pure price action reading, phase analysis methods like Elliott, Dow, and Wyckoff, hundreds of technical indicators, many different types of lines, channels, support and resistance, divergence, volume analysis, volatility analysis, cycle analysis, and the list goes on. All these methods are either based on price, volume, or both. Since price is more important than volume, then it makes sense to start studying its basic elements before anything else. Candlesticks are the foundation of price action reading, so they are the starting point of the price action reading journey. In summary, the candlestick is where it all begins, so it makes sense to understand it as deeply as possible, and as a consequence, all the rest that comes later will be easier to understand and better utilized too. Many traders believe that they have a good grasp on candlesticks, but as you are about to find out, there's a lot more to it than what meets the eye. Another important detail here is that the most value we can extract from technical analysis is not in learning the various tools and methods. It's in learning how other traders will react to the various tools and methods. Beyond that, learning the limitations and disadvantages of a particular technique or method also holds a lot of value. So even if you're not going to use all the techniques and patterns presented here, you should learn what they are and their limitations. Before we move on to the basics of candlesticks, it's useful to briefly understand the historical context in which they emerged. The Japanese are famous for their knowledge of trading, and we can trace their trading activity back to the 1600s. The emergence of trading in Japan has a peculiar background, and it happened indirectly because of war, as many revolutionary things do. In the year 1600, the general Tokugawa won the Battle of Sekigahara against the Japanese feudal lords. General Tokugawa resided in what today is the territory of Tokyo, so he demanded that the Japanese feudal lords move there with their families. The feudal lords could return to their provinces, but their families were required to stay in Tokyo as hostages. After losing the battle, the feudal lords' only source of income was rice collected as tax from the peasants that worked in their land. This rice that was collected as tax began to be stored in what today is Osaka, since it could not be transported to Tokyo. One peculiar detail about the feudal lords is that they had an extremely expensive lifestyle. They would sell the stored rice in Osaka to maintain this expensive lifestyle. One interesting detail is that they would also sell rice that was not even harvested yet. This used to be called empty rice contracts. This was the beginnings of a futures market. The negotiation of empty rice contracts obviously generated a lot of speculation, and it was precisely at this time that Japanese technical analysis began. A lot of the things that retail traders see on the internet nowadays, believing such things are a result of modern wisdom, came from this ancient era. For instance, trade the reaction to the news instead of the news itself. In every uptrend, there is the imminent potential for a downtrend to begin, and vice versa. And perhaps most importantly, the perception that the behavior of human beings is key for the understanding of the market are all ideas and intuitions that were born at this time. In fact, this notion of human behavior in relation to the markets, which is called trading psychology nowadays, predates price charts. Such notions came from one of the iconic Japanese rice futures traders called Munehisa Homa, who was called the god of markets at the time. These basic notions were found in a book written by Homa called The Fountain of Gold, the three-monkey record of money. The three-monkey expression is a reference to see no evil, hear no evil, and speak no evil from the wise monkeys. To Homa, see no evil is associated with the fact that when you see a trend, you should not get caught up in it. In other words, don't trust the trend blindly. Instead, question its existence. Hear no evil is associated with the idea that you should not trade the news, but instead, trade the reaction to the news. The news itself is not as important as how people react to it. That is what ultimately will change price. Speak no evil refers to the idea that you should not tell other people what you're going to do in the market. That had a lot more importance at that time than it does nowadays. In the highly competitive and liquid markets of today, the sharing of trading insight became an advantage instead of a problem. Candlesticks, in the way we know and use them, cannot be traced back to one person exactly. It's more likely that it has been a long process of different people making small contributions that ended up in a final idea. Candles themselves, as we know them, probably emerged at the end of the 19th century. However, we can trace the path that led to candles. It's a clear evolution from different types of charting methods. In the first moment, there was the stopping chart, which is simply the record of the closing price of a session. The closing prices were linked by diagonal lines or horizontal and vertical lines like so. The next step is what is called pole charts, which record the high and low of each trading session or period. The third step is a form of bar chart that combines the elements of the stopping chart with pole charts, so the close, high, and low prices are recorded like so. The type of charting method that immediately preceded candlesticks is called anchor chart, and it is essentially the same as candlesticks, but displayed in a different way. They display the four prices, but the open is a straight line while the close is an arrow. The interesting thing about candlesticks is that it becomes immediately obvious if the close is higher or lower than the open by the color of the candle. It's important to give credit to important authors on the topic of candlesticks. Gregory Morris, Steve Nissen, and Thomas Bukowski have made great contributions to the spread and study of candlesticks in the West. Now that we have a notion about how candles emerged, we can begin to understand them in more practical terms. In this section, we'll analyze candlesticks from the ground up, and you'll learn some interesting properties that you might not know yet, so stay tuned. candlestick is nothing more than a snapshot of price action. If we imagine that the continuous fluctuation of price is like a movie, the candlestick is a snapshot of this movie that is taken in equal intervals of time. To make this absolutely clear, observe the following illustration. Imagine a series of price fluctuations like so. This series of price fluctuations has no time frame yet. Now imagine that we divide the series of price fluctuations in equally spaced intervals of time like this. Let's say that each of these rectangles represent 1 hour, but they could represent any other interval of time. The candlestick is a snapshot of what happened with the price fluctuations in each of these rectangles. In other words, the candle will capture the highlights of what happened with price in each of these rectangles. These highlights are the most important price levels that occur throughout the formation of each rectangle. If we think about this logically, we can perceive that the most important prices occur at the beginning and end of each rectangle, and the highest and lowest point that price reaches within each rectangle. The price at the beginning of the rectangle is the open. The one at the end of the rectangle is the close. The highest point that price reaches within the rectangle is the high, and the lowest point is the low. This is the origin of the 4 prices of the candlestick: the open, high, low, and close. There are a couple of important details here. Notice that sometimes the close or the open will be equal to the high or the low. That happens when price opens or closes in the highest or lowest place of the rectangle. Notice also that the close of one rectangle is the open of the next rectangle. The only exception to this rule is when there are gaps between the close of one candle and the open of the next one. In summary, we can condense this series of price fluctuations into this set of candlesticks. The candlesticks organize the series of price fluctuations in terms of time. Let's take a closer look at the elements of a candlestick individually. The space between the open and the close is displayed as a thick bar called the candle body. If the close is higher than the open, we have a bullish body, because that usually implies a bullish price fluctuation inside a candlestick, even though that is not always the case, as we'll see in a moment. Bullish candles are often displayed as green or white bars in the chart. If the close is lower than the open, we have a bearish body, because that implies a bearish price fluctuation inside a candlestick. As is the case with the bullish candles, bearish candles are not always what they seem to be. The terms bullish and bearish are a reference to how bulls and bears attack their prey. Bulls throw their prey up in the air when they attack, so an upward price movement is called bullish. Bears, on the other hand, throw their prey down when they attack, so a downward price movement is called bearish. The thin lines above and below the candle are called wicks, shadows, or tails. In a bullish candle, the upper shadow is the space between the close and the high, and the lower shadow is the space between the open and the low. In a bearish candle, we have the opposite. The upper shadow is the space between the open and the high, and the lower shadow is the space between the close and the low. It's important that you realize that there is a very large number of different shapes that candlesticks can assume. One major detail here is that we can infer the movements of the series of price fluctuations by looking at the candlesticks. Notice that candlesticks are not exactly price action. Real price action is happening behind the candlesticks in a way, but since we need candles to organize price in time, we need to read price between the candles, so to speak. Just like we can map a series of price fluctuations into a set of candles, we can also map a series of candlesticks into another candle. This is the idea of composite candlesticks. For example, let's take the series of candles that we extracted from the hypothetical series of price fluctuations we just observed. If we observe the open, high, low, and close values of this series, we can reach another candle that summarizes the whole price action. Notice that the process that creates one candle from a series of price fluctuations is the same process that can create different time frames. One important idea that you should understand also is that candlesticks are fractal. A fractal is simply a pattern that repeats inside and outside itself. In other words, there are smaller candles inside bigger candles, and inside the smaller candles, there are even smaller candles. If you wish to understand the elegant mathematics behind fractals and trading, I've created a course specifically designed for that purpose. You can find a link for this course in the video description. The idea that candles are fractal leads to the fact that the time frame you analyze doesn't alter the nature of candlesticks. The thing that changes in different time frames is the size and time duration of candles. The way candles behave and evolve remains intact. This is precisely the reason why it doesn't matter which time frame you analyze. Price action is the same in all time frames and in all markets. The only thing that changes is the size and time duration of candles. Proof of that is that if I show you two charts of different time frames while hiding the time frames and chart scales, you will not be able to tell the difference. Here we have two different time frames for the Euro USD. Pause the video for a moment and try to guess which time frames you are seeing. I've hidden the vertical and horizontal axes so you are not tempted to cheat by observing the scales. On the left we have the 1 minute time frame, and on the right we have the 4-hour time frame. Don't feel bad if you didn't guess correctly because you're not supposed to. As I said, there is no difference between time frames other than the relative size of candles and their duration. So you should not be able to tell the difference just by looking at the candles. Many traders believe that trading techniques work differently in different time frames, but that is not true. For example, a support and resistance line works in the exact same way in the 1 minute chart or in the monthly chart, so the only difference is the size and time duration of price movements. One important thing to know about candlesticks is that there is some ambiguity in their mechanics. I can give you a very simple visual example of that. Observe these two hypothetical situations. There are two different series of price fluctuations, and both lead to the exact same candlestick. The upper series forms the low before the high, and the lower series forms the low after the high. Notice that if we look at the price fluctuations, we'll see that they do not imply the same movement. The upper one produces a movement that is similar to an uptrend. The lower one, however, produces a movement that resembles a sideways market. This is one of the problems with candlesticks. They can be ambiguous. A candle that looks bullish might not be hiding a bullish movement behind it, as you can see. The same happens with bearish candles too. However, this ambiguity is a price we must pay if we want to organize this series of price fluctuations into a set of analyzable candlesticks. Another way of looking at this is that the fundamental property of candles organizing price action in terms of time comes with the cost of information loss. There are many useful properties in candlesticks, so in general, this is a small price to pay. We can partly reduce this problem by observing how candles evolve over time. In summary, candlesticks are not the same as price action. Price action is the continuous fluctuation of price, so it's like a movie. The candlestick is like a series of snapshots of this movie. These snapshots are taken in equally spaced intervals of time. In other words, candlesticks are one way of visualizing price action, but they are not the only way, as we'll see in a moment. Candles are fractal, meaning that a set of candles can be represented into one single candlestick in a larger time frame. Another way of looking at this is that a candle is formed by a set of smaller candles. The mechanics of how candles are formed and the way they evolve over time remains the same in any time frame. The only thing that changes is the size and time duration of candles. That means that trading techniques work in the same way in all time frames. Because candlesticks compress information for the sake of organization, there is information loss, and that creates some ambiguity in how candlesticks are interpreted. The main way of minimizing this problem is by observing how candles evolve over time. In this section of the course, we'll briefly explore other types of charting methods, since that can provide an additional edge to traders for reasons that will become clear in just a moment. As we saw previously, candlesticks are not the same as price action. Candlesticks are one way of representing price action. The Japanese are known for their contribution to other ways of representing price action in the chart beyond the candlestick. What dictates how candlesticks are going to appear in the chart is the time frame. That means that once the trader chooses a time frame, the time it takes for a candle to form is always the same. What varies is the shape of the candlestick itself. However, the Japanese came up with other ways of representing price that are not necessarily based on time alone. Some of these other ways are based on a combination of time and price, or just price fluctuation itself. The reason traders might care about this is that these other ways of representing price might give a different perspective about the continuation or reversal of a trend that could not be obtained with the candlestick chart in isolation. What follows is a very brief exploration of these different ways of representing price that mainly originated from the Japanese speculators. I will show how the different charting methods are built and their basic signals. However, this is a quick detour to expand your knowledge on a related subject. We'll quickly go back to candlesticks right after. The different charting methods are called Renko, line break, Kagi, and Heikin-ashi. We'll start with the Renko chart. In a Renko chart, the trader chooses the size of the Renko bar instead of choosing the time frame like it would happen in a candlestick chart. In other words, Renko charts are price-based instead of time-based. Renko bars are sometimes referred to as Renko bricks. Let's imagine that the trader is looking at a forex chart and he chooses the Renko bar size of 10 pips. All of the bars in the chart will always have a body with exactly 10 pips. What changes is the amount of time it takes for the market to advance 10 pips. For example, let's imagine we have a bullish Renko bar representing that the market has advanced 10 pips to the upside. For a new bullish Renko bar to form, the market must advance 10 pips to the upside. This might take a few seconds only, but it might take a few minutes or maybe hours. For a bearish Renko bar to form after a bullish bar, the market has to go down 20 pips, which is double the size of the Renko bar. In summary, for price to create a continuation, you must advance the same amount of the predetermined Renko bar. To create a reversal, it must go twice the amount of the predetermined Renko bar on the other direction. This is a real example of a Renko chart in the S&P futures. One common way of determining the size of the Renko bar is to observe the value of the average true range of 14 periods in a given time frame. For example, in this chart, the Renko size is the same as the average true range of the last 14 hours, since this is the hourly time frame. Renko charts are known for their capacity to filter out a lot of the noise in price action. This has advantages and disadvantages. Filtering out the noise in price action allows the trader to be less overwhelmed by price activity, but at the same time, it removes the possibility of extracting useful and meaningful information out of the price chart. The nuanced relationship between buyers and sellers is much easier to see in candlestick charts, precisely because a lot of this meaningful information resides in the apparently chaotic oscillations of the candlesticks. However, chaos is not random noise. It's a higher degree of order that requires knowledge to be understood. There are many ways of using Renko charts, but this is not the time to go deeper into this subject. The basic signal in a Renko chart occurs when bars change color. In other words, when a bullish bar appears after a bearish bar, there is a buy signal. When a bearish bar appears after a bullish bar, there is a sell signal. Obviously, there's a lot more you can do on a Renko chart, but as I said, this is not our main focus for this course. This basic signal works remarkably well in certain cases, as you can see here in this chart. The signal can be used in a stop and reverse manner. However, you would also find situations like this, where this basic signal will generate many bad trades that will wipe out the profits you would have made in the previous scenario. In conclusion, the trader must have other ways of filtering this basic signal. Notice that since Renko bars are always the same size, what changes is the time it takes to form it. That results in a nonlinear horizontal axis in the chart. In other words, Renko bars don't form in equally spaced intervals of time. That happens because price action advances in different speeds. Fast markets create a lot of Renko bars in a short amount of time. and that has the effect of expanding time in the x-axis of the chart. Slow markets create only a few wrinkle bars in a long time, and that has the effect of contracting time in the x-axis of the chart. Some traders use the wrinkle chart as a trend filter, for example, because of the way the chart is built. Another type of chart is the line break. The bars in this chart are called lines. The rationale goes as follows. Suppose that the previous line was bullish. If the current period closes above the last line, a new line will be drawn. If price closes within the range of the previous line, no line is drawn. Notice that the size of the lines can vary. Let's say that price closes higher than the previous line for a few more lines. The question that emerges is what needs to occur for a bearish line to appear. A bearish line will be drawn if price closes below the last X lines. This X, as a default, is 3, hence why this chart is sometimes referred to as 3-line break. But the trader can set any number for X. The higher the X, the smoother the chart, but also the more lag there is in the reversal signal. Depending on the number of breaks the trader wants to use, the chart will look completely different. Line break charts are supposed to give an advantage in filtering out the often deceptive mechanics of price reversals at the same time that it provides a clearer and smoother view of trending markets. In a way, the line break chart does a similar thing to the wrinkle chart. The higher the number of line breaks, the smoother the chart, but also the later into a reversal the signal occurs. Here we find the same trade-off with finding smoothing indicators like moving averages. The smoother the signal, the more lag it has. The basic buy and sell signals of the line break chart are quite simple. A buy signal occurs when a bullish line appears after a bearish line. A sell signal occurs when a bearish line appears after a bullish line. That's also very similar to the basic signals found in the wrinkle, as we can see in this chart. Notice that, like wrinkle charts, sometimes the signal is incredibly reliable and sometimes is completely unreliable, like we can see in this other chart. We can go a little further with line break charts and detect signals based on the progression of lines that are classified as big or small, roughly speaking. Big bullish lines are denominated as white suits. Small bullish lines are denominated as necks. Big bearish lines are denominated black suits, and small bearish lines are denominated as black shoes. The Japanese came up with the following rationale for a buy signal. The first line is a black shoe, meaning a small bearish line, which simply represents the slowing down of selling activity. The second line is a white suit, meaning a big bullish bar, which represents a powerful reversal to the upside. Following that, there is a neck, meaning a small bullish line, which represents the possibility of buyers taking a break after the previous large move and before continuing to the upside. In this chart, you can see two successful examples of buy signals following this logic. The signal chain is a little better than simply observing the 3-line break because it filters a few of the unreliable line breaks that naturally occur in this charting method. The sell signal goes as follows. The first line is a neck, meaning a small bullish line, which simply represents the slowing down of buying activity. The second line is a black suit, meaning a big bearish bar, which represents a powerful reversal to the downside. Following that, there is a black shoe, meaning a small bearish line, which represents the possibility of sellers taking a break after the previous large move before continuing to the downside. In this chart, you can see an example of a successful bearish signal, but you can also see 4 examples of unsuccessful bullish signals on the right and 1 successful bullish signal on the left. These examples we just saw happened using the standard 3-line break signal. But as I pointed out earlier, we can increase the number of line breaks to make the price chart smoother at the expense of adding lag to the signal. In this chart, I exaggerated this idea, so it becomes clearer. Instead of using a 3-line break setting, I used a 10-line break setting. Notice how price action is smoother, but when reversals occur, they are more abrupt. Like I said, this has advantages and disadvantages. The disadvantage is that the added smoothness comes with the cost of lag, and the advantage is that the signals are very clear and easy to see. Another type of price-based charting method is the Kagi chart. Kagi charts are formed by vertical and horizontal lines. The notion of trend can be displayed in one of two different ways, by a change in thickness of lines or by a change in color. Let's first observe an example using the change in line thickness. A vertical line shows price has moved in one direction, to the upside in this case. A horizontal line will not appear until price reverses by a predetermined amount, which is usually 4% from the local high. If price continues going down from this point, a vertical line to the downside will be drawn. A new horizontal line will only be drawn if price reverses 4% to the upside from the local low. A line will change its thickness if it surpasses a previous low or high. In this example, once the line surpasses the previous high, it becomes thicker. Once it surpasses a previous low, it becomes thinner. Notice that it doesn't matter if it's thick or thin. What matters is the change in thickness. The other way of representing this breakout of highs and lows is by a change in color instead of a change in line thickness. In this case, a logical example will be a green line once it surpasses a previous high, and the line turning red once it surpasses a previous low. Notice how there is a special attention to the breakout of highs and lows implicit in the Kagi chart, something that has been explored in many different ways until this day in technical analysis. The Kagi chart also works irrespective of time. It doesn't matter how much time it takes for price to reverse. The chart only progresses once price reverses by the predetermined amount set by the trader. The most basic signal in the Kagi chart occurs when lines change thickness or color, meaning when a previous high or low is broken. In this chart, you can see several examples of buy and sell signals in the Australian dollar. Notice that most of these signals are deeply unreliable. A very common pattern is what the Japanese traders call tweezer top or tweezer bottom, which are simply double tops or bottoms that mark levels of support and resistance in the chart. Buy and sell signals tend to be a little less unreliable after tweezer tops or bottoms. Kagi traders also look for analogous versions of common chart patterns in the Kagi chart, such as head and shoulders and reverse head and shoulders, for example, but I will leave that for another day. Another type of chart that is closely related to the candlestick is the Heikin-Ashi chart. One of the goals of this charting method is to remove some of the noise that occurs in regular candlestick charts. The expression Heikin-Ashi means average bar in Japanese, and it smooths price action based on the following formulas. This is just for illustration. You don't need to know these formulas to trade using Heikin-Ashi charts. This type of chart has the advantage of smoothing out some of the price noise, although this can be a disadvantage sometimes. The main interpretation of Heikin-Ashi candles goes as follows. Long bullish candles without lower shadows represent bullish power. Long bearish candles without upper shadows represent bearish power. Small candles with upper and lower shadows represent indecision. In this chart, you can see a candlestick chart on the bottom and the Heikin-Ashi chart on the top. Observe how the top chart is slightly smoother than the raw candlestick chart. Notice also how strong trending movements produce Heikin-Ashi candles with only one shadow, while indecisive movements create candles with both shadows. There are other charting methods beyond what was presented here, but this is a candlesticks course and not a charting methods course, so I want to contain myself to the methods that I find to be most relevant to the topic in question. Candlesticks, Renko, Kagi, line break, and Heikin-Ashi are all charting methods we inherited from the iconic Japanese speculators. In summary, some of these charting methods are better for smoothing price action, and some are better for extracting useful information about buyers and sellers from apparently chaotic price movements. Some traders use price-based charts to establish the trend, and time-based charts for entry and exit signals, for example, but that's something we will explore in another time. The reason we want to focus on candlesticks first is because they are still the most useful charting method, although there is benefit in combining candlesticks with other charting methods depending on the strategy. Candlesticks do not attempt to filter price or smooth it out, and that's precisely why they are so powerful. They simply organize price action instead of trying to filter it. Whenever price is smoothed out or filtered, it loses its capacity to provide meaningful information about buyers and sellers in a detailed way. At this point, it should be clear to you that learning about candlesticks is unavoidable if you want to learn how to trade with price charts. The financial market is basically a complex model of the world. Price action contains not only the information that is directly related to the financial instrument in question, but also all the indirectly related information to some degree. That means that an enormous amount of information is compressed into one single variable, which is price. What I'm getting at here is that the most useful type of charting method is the one that allows the greatest amount of information to be extracted from price, and candlesticks do a good job at that, at least in comparison to the other charting methods. Other charting methods that attempt to smooth the noise contained in candlesticks are basically going in the opposite direction that they should. The trader should not want less information in the chart. The trader should want more information so he can understand the market better. In other words, the most useful charting method is the one that contains more information about price action, not the one that attempts to filter it, because there is already an enormous loss of information in price. Filtering it only makes it worse. Now you have a good understanding of how candlesticks work on a basic level, so it's time to move on to the famous candlestick patterns. Candlestick patterns are simply specific combinations of candles that signal buy and sell opportunities in the market. These patterns have been created over time, and many of them came from the Japanese, but not all. Before we understand the various patterns, we must be familiar with a couple of ideas. These ideas are pattern sentiment and trend sentiment. The pattern sentiment indicates what's going to happen with price after the pattern. In other words, a pattern can be either bullish, bearish, or neutral. A bullish pattern indicates that price will go up after the pattern. A bearish pattern indicates that price will go down after the pattern, and a neutral pattern indicates indecision. The trend sentiment relates to market activity before the pattern. A bullish trend sentiment means that price has been going up, and a bearish trend sentiment means that price has been going down. When pattern and trend sentiments agree, we have the signal for a continuation. When pattern and trend sentiments disagree, we have the signal for a reversal. If price is going up and then a bullish pattern appears indicating that price will go up after the pattern, we have a bullish continuation. If price is going up and then a bearish pattern appears indicating that price will go down after the pattern, we have a bearish reversal. If price is going down and a bearish pattern appears indicating that price will go down after, we have a bearish continuation. If price is going down and a bullish pattern appears indicating that price will go up after, we have a bullish reversal. Another way of looking at this is that the terms bullish and bearish indicate what is going to happen with price after the pattern appears, and the terms reversal and continuation relate to how the pattern sentiment changes the trend sentiment. With that said, with each candle pattern, we are going to study 4 elements: the function, the identification, the logic, and the trade. The function relates to what we just saw, meaning we'll see the function of each pattern. It can be a bullish reversal, bullish continuation, bearish reversal, bearish continuation, or simply indecisive or neutral. One important detail here is that sometimes the theoretical function of a pattern will diverge from its real function, as it is demonstrated in the work of Thomas Bukowski. The identification is how the trader actually scans the price chart for these patterns. The logic is the reasoning behind each pattern. In other words, why the pattern has a particular function. The trade is simply an example of how the trader can use each pattern as a setup to trigger buy and sell trades. This includes the entry, the stop, the target, and the ideal risk-reward ratio of each pattern. Before we proceed with the patterns, you must be aware of a few trade guidelines that will make sure you don't lose money unnecessarily when attempting to master these patterns. It's important that we establish a few rules regarding the act of trading not only candlestick patterns, but any type of trading signal. That's because trading is not just about recognizing some sort of pattern in the chart and acting on it. The series of trades that you take will inevitably produce long-term consequences, so it's up to you to tilt these consequences to the positive side by acting correctly right from the start. What follows is a brief list of things you can do to act correctly in the short term in a way that will create the possibility of continuing to trade over time, meaning the minimization of losses and avoidance of known pitfalls. 1. Define a stop-loss order before entering the trade and stick to it. This is common knowledge among traders at this point, but it can never be stressed enough. You should always use a stop-loss order. If you trade without a stop-loss, you will be at the mercy not only of the potentially wild movements of the market, but also to the potentially wild reactions you will have to these dangerous market movements. There are parts of your behavior that you cannot control under certain circumstances, and it's a big mistake to think that any amount of willpower can override deeper impulses like revenge trading or the fight-or-flight reaction when risk increases too much, for example. Once you set a stop-loss, you cannot change it unless it is to decrease risk if you have a logical reason to do so. You can never increase the risk, otherwise it makes no sense to set the stop-loss in the first place. You cannot properly calculate risk-reward ratio without having a stop-loss first, and risk-reward ratio is essential. The bottom line is, you must define a stop-loss before you enter the trade, and once you set it, you cannot change it unless it is to decrease your risk. But even that requires some knowledge in order to be properly done. 2. Respect the target. Respecting the stop-loss is one thing. Respecting the target is another. Both are equally important. When traders want to change their stop-losses in order to avoid being stopped out, they are displaying risk-seeking behavior with the hope that the market will turn around. When traders want to lock in a profit before the market reaches the target, they are displaying risk-averse behavior because they are afraid the market will turn and they will regret not realizing the small profit they had. All of this is a paradox because seeking risk when you are losing and being averse to risk when you are winning are the precise opposite of what should happen. If you don't respect the target, you cannot maintain a certain risk-reward ratio. The risk-reward ratio that really matters is the one at the end of the trade, not the one you planned before the trade. If you plan to get a 1-2-3 trade, but it closes with a 1-1 because you changed the target in the middle of the trade, it makes no sense to set a risk-reward goal in the first place. In summary, once you set a risk-reward goal, you are setting a commitment, and you honor that commitment by not changing the stop and the target unless it is to decrease your risk in the trade. Never increase the risk. That means that sometimes the market will hit your stop loss and then it will do what you anticipated, leaving you frustrated. That's normal. It's part of trading because price action is noisy. So if you want to have optimally placed stops, you also need to contend with this problem. The bottom line here is that a stop loss, a target, and a planned risk-reward ratio will only make sense if you respect them until the end of the trade. That's hard to do because there are different kinds of temptations that happen in the middle of the trade. 3. Maintain a good risk-reward ratio. The risk-reward ratio is simply the ratio between the stop loss and the target. A good risk-reward ratio gives you margin of error, which means that you can make a lot of mistakes and still make money. The reason you need the possibility of making a lot of mistakes is because technical analysis is far from being perfect, and trading is about speculating the future of price, which is always uncertain no matter how well you understand the market. It's not realistic to think that you will win all the time. There are ways of tilting the odds to your favor, but there is no way of tilting the odds completely to your favor. The point I want to make here is that for you to maintain a good risk-reward ratio, you need to assess if the market has the potential to travel enough in order to hit your target. It's not just a matter of detecting a buy or sell signal. That requires that you understand other aspects of technical analysis beyond candlesticks. A good risk-reward ratio is around 1 to 3. That will give you 75% margin of error, meaning that out of 100 trades, you can lose 75 and still break even. If you win more than 25 trades out of 100, you will make money assuming you always risk the same amount in your trades. If you don't understand why a 1-to-3 risk-reward ratio trade gives you a 75 margin of error, it's very simple. Imagine, for simplicity's sake, that your stop losses are always equal to $10 and your targets are always equal to $30. The risk-reward ratio is 1-to-3. Imagine also that you win the first trade you make, although that is certainly not a requirement. You've made a profit of $30. That means you can lose the next 3 trades and break even. In other words, you need 3 losses to wipe out 1 profitable trade. You can lose 3 trades out of 4 and break even. If you can lose 3 trades out of 4 and break even, you have 75% margin of error. 4. Integration. One of the most important ideas in technical analysis is something called integration of techniques, which is simply trading when different techniques intersect at the same time and place in the charts. The reason technical traders must do this is because by combining different techniques together or integrating them, the trader increases the chances of success in any given trade. If you rely on just one technique to enter your trades, you are likely to be disappointed by the results in the long term. The trade setups you'll see in this free course are based on candlestick patterns alone, but keep in mind that you should never trade based on only one technique. High-quality trades occur when there is the intersection of techniques that are devoid of lag. In other words, you can use the stop, trigger, and targets presented based on candlestick patterns, but you need to make sure that there are other technical signals intersecting with the pattern. In other words, you can use some of these candlestick patterns as triggers, but not as full strategies. 5. Crawl before you can walk, walk before you can run. Everybody talks about what to do to win in the market. Very few talk about learning how to lose first. There is an art to losing trades in the right way. The way you manage your trades, your risk, and your behavior is more important than the techniques you use in that sense. On the other hand, good behavior and good risk management are not capable of producing profits if you have bad technique. There are right ways of losing and wrong ways of winning in trading, but that's a more complicated subject for another moment. 6. Practice trades on a demo account. Demo accounts exist for a reason. Demo accounts allow you to trade fictional money so you can master techniques without losing money unnecessarily and without the problem of managing emotions and technique simultaneously. Trying to figure out the technical part of trading while you deal with the challenges of risk management and trading psychology is a recipe for disaster. You will end up mastering none, and you will lose money unnecessarily. You can only worry about the challenges of risk management and trading behavior once you master the techniques you want to use. 7. Beware of performance measurement. Most traders have no idea how to measure their performance, despite the fact that they are certain that they do. I can state that because I talk to hundreds of traders around the world, and most of them have absolutely no idea how to measure performance objectively. Making a few winning trades makes the trader feel good and improves their confidence, but it doesn't mean the trader knows what he's doing, and it certainly doesn't mean that this performance will continue like this forever. Most retail traders think in terms of daily performance over a few days. That's far from being enough. In the institutional domain, a minimum of 36 periods of monthly data is necessary for statistically significant results to be drawn. Beyond that, performance is not measured by comparing your current performance against your past performance. It's measured by comparing risk-adjusted performance metrics like the Sharpe ratio of your performance relative to a benchmark, but that's a subject for another time. For the time being, please know that making money in the short term doesn't mean you know how to trade. Good trading performance in the past doesn't mean it will continue, and trading performance is not only a function of your skill. There are variables that affect it that are outside the trader's control. 8. Don't risk too much. Traders want to risk a lot of money because they want to get rich quickly. However, risking too much is a guaranteed way of losing everything you have. That happens for a variety of reasons. Beyond that, risking more money than you should makes you constantly worry about your emotions instead of worrying about your analysis and that just never ends well. Never risk more than 1% of your capital in one single trade. In fact, 1% is already pretty high. 9. Trading is speculation. Many traders commit the mistake of thinking that trading correctly will yield good results 100% of the time. That's not how it works in reality. Trading is particularly difficult and deceptive sometimes because acting correctly does not always yield a good result, and sometimes acting incorrectly yields an illusory good result. That is the case in the short term. In the long term, if you act correctly, your results should be positive overall, although that is also not a guarantee, and it also doesn't mean there won't be long periods of negative performance. Trading is tricky because it's very easy to do the wrong thing while thinking you're doing the right thing. That's why you need to educate yourself as much as possible in relation to how markets work, how different market players act, and etc. Before we finally move on to the candlestick patterns, you need to be aware that sometimes the theory of how a pattern should work diverges from how it works in practice. That is based on the extensive work of Thomas Bukowski on the statistics of candlestick patterns. Bukowski measured the statistics of various patterns in the 500 stock of the S&P 500 over a period of 10 years, accounting for more than 4.7 million candlesticks. The result is the knowledge of how candlestick patterns work in real markets. In this course, you'll see the counterpoint between the theory of how candlestick patterns should work and the statistics that Bukowski found. Please support the author and buy Bukowski's book called Encyclopedia of Candlestick Charts if you want to learn about the statistics of these patterns with an incredible level of detail. Please note that even though Bukowski's work is comprehensive, the probabilities associated with trading patterns vary over time since the market is highly dynamic. So just because a pattern demonstrated to be accurate in the past, it doesn't mean it will continue to do so. The main reason for this is that the financial market is a system that reacts to predictions, and this feature creates an extremely high level of dynamism and unpredictability. In this course, I combined Bukowski's findings with my interpretation of the logic behind various candlestick patterns and the appropriate stop, trigger, and target orders associated with each pattern. Now you have a solid foundation of candlesticks, so it's time to explore the many candlestick patterns available. As I said earlier, we'll explore the function, the identification, the logic, and the trade setup of each pattern. Bearish abandoned baby. The bearish abandoned baby works as a bearish reversal pattern in theory and in practice. This pattern is formed by 3 candles. The first one must be bullish, but it can be big or small. The second candle must be a doji, whose lower shadow gaps above the upper shadows of both first and third candles. This is the most important aspect of this pattern. The third candle must be bearish, but it can be big or small, just like the first candle. For a bearish abandoned baby to appear, price must be in an uptrend, which is confirmed by the first candle in the pattern. After that, price gaps up, which is further confirmation of the uptrend, but then it ends up forming a doji, which is a sign of indecision. In other words, even though price gapped up, which is a sign of power from buyers, the doji means that the sellers appear to counteract the buyers. The third candle demonstrates who wins this battle that took place in the doji, which in this case are the sellers. When price gaps down after the doji and forms a bearish candle, we have indication of a bearish reversal. Trading the bearish abandoned baby is very simple. A short position can be triggered at the open of the next candle after the pattern. The stop loss must be placed a few ticks above the high of the doji, and the target should be around 3 times as large as the stop loss. Bullish abandoned baby. The bullish abandoned baby works as a bullish reversal pattern in theory and in practice. This pattern is formed by 3 candles. The first one must be bearish, but it can be big or small. The second candle must be a doji whose upper shadow gaps below the lower shadows of both first and third candles. This is the most important aspect of this pattern. The third candle must be bullish, but it can be big or small, just like the first candle. For a bullish abandoned baby to appear, price must be in a downtrend, which is confirmed by the first candle in the pattern. After that, price gaps down, which is further confirmation of the downtrend, but then it ends up forming a doji, which is a sign of indecision. In other words, even though price gap down, which is a sign of power from sellers, the doji means that buyers appear to counteract the sellers. The third candle demonstrates who wins this battle that took place in the doji, which in this case are the buyers. When price gaps up after the doji and forms a bullish candle, we have indication of a bullish reversal. Trading the bullish abandoned baby is simple. A long position can be triggered at the open of the next candle after the pattern. The stop loss must be placed a few ticks below the low of the doji, and the target should be around 3 times as large as the stop loss. Above the stomach. The above the stomach pattern works as a bullish reversal in theory and in practice. This pattern is formed by 2 candles. The first one is bearish, and the second one must open and close above the middle point of the first candle in the pattern. The first candle confirms the downtrend in which it appears. The second candle in the pattern is where the shift happens. The fact that it opens with a gap up and closes at or above the middle point of the first candle is a sign of power from buyers. This pattern is more common in stocks where gaps appear more often. The trigger for the long trade occurs at the open of the next candle. The stop loss should be below the low of the first bearish candle, and the target around 3 times as large as the stop. Below the stomach. The below the stomach pattern works as a bearish reversal in theory and in practice. This pattern is formed by 2 candles. The first one is bullish, and the second one must open and close at or below the middle point of the first candle in the pattern. The first candle confirms the uptrend in which it appears. The second candle in the pattern is where the shift happens. The fact that it opens with a gap down and closes below the middle point of the first candle is a sign of power from sellers. This pattern is more common in stocks where gaps appear more often. The trigger for the short trade occurs at the open of the next candle. The stop loss should be above the high of the first bullish candle, and the target around 3 times as large as the stop. Advanced block. The advanced block is a bearish reversal pattern in theory, but in practice, it works as a bullish continuation most of the time. Recall I said previously that some patterns work differently from their theory. What matters the most is what we see in real charts, of course. This pattern is formed by 3 bullish candles. In the second and third candles, the open must occur within the body of the previous candle. Another important detail is that the candle bodies get progressively smaller while upper candle shadows get progressively larger. The advanced block shows 3 different bearish signs within bullish candles. The first sign is price gapping down and opening within the previous candle's body. There must be some selling pressure for that to happen. The second sign is the gradual decrease in candle bodies. Since all candles in the pattern are bullish, a gradual decrease in candle body implies a decrease in buying power. The third sign is the gradual increase in the upper shadows. This implies even more selling pressure. This is the reason this pattern is considered to be a bearish reversal in theory. However, the real market data shows us that this pattern works as a bullish continuation most of the time. One plausible explanation for that is that even though there are bearish signs embedded in the bullish candles, they are not enough to override the existing buying pressure. The trader must be careful when attempting to trade this pattern. Using evidence from the real world, we should expect this to work as a bullish continuation most of the time, but even with this evidence, it's hard to define a logical stop-loss placement. For this reason, trades should not be triggered based on this pattern. Since it implies a bullish continuation most of the time, it can be used as a sign to continue in a pre-existing long trade, for example. Bearish belt hold. The bearish belt hold works as a bearish reversal pattern in theory and in practice. The bearish belt hold is formed by 1 candle only. This candle must have a large bearish body. It should also appear after price has produced successive bullish candles. In other words, the bearish candle that signifies a bearish belt hold should be somewhat of a surprise around the bullish candles. In this pattern, the large bearish body demonstrates a sudden burst of selling pressure and perhaps an increase in volatility along with it that was not expected by buyers. This suggests that control of the market has now shifted hands from buyers to sellers. The trigger for the short trade occurs at the open of the next candle, with a stop loss above the highest high over the last 5 candles or so, and the target should be around 3 times as large as the stop loss. Bullish belt hold. The bullish belt hold works as a bullish reversal pattern in theory and in practice. The bullish belt hold is formed by one candle only. This candle must have a large bullish body. It should also appear after price has produced successive bearish candles. In other words, the bullish candle that signifies a bullish belt hold should be somewhat of a surprise around the bearish candles. In this pattern, the large bullish body demonstrates a sudden burst of buying pressure and perhaps an increase in volatility along with it that was not expected by sellers. This suggests that control of the market has now shifted hands from sellers to buyers. The trigger for the long trade occurs at the open of the next candle with a stop loss below the lowest low over the last 5 candles or so, and the target should be around 3 times as large as the stop loss. Bearish breakaway. The bearish breakaway works as a bearish reversal in theory and in practice. This is a rare pattern composed by 5 candles. The first must be a large bullish candle. The second must also be bullish, and it must open with a gap in relation to the first candle. Even though it must open with a gap, the shadows of the first 2 candles are allowed to overlap. The third candle can be bullish or bearish, but it must produce a higher close in relation to the second candle. The fourth candle must be bullish and produce a higher close than the previous candle. And finally, the fifth candle must be a large bearish candle that closes within the gap produced between the bodies of the first 2 candles in the pattern. Judging by the long list of overly specific requirements, you can see why this is a rare pattern. Even though there are a lot of requirements of identification, the logic behind the pattern is simple. There are 2 main factors: the gap and the final bearish candle. It's precisely the fact that the bearish candle violates the gap territory that makes this a bearish reversal pattern. In other words, after the gap and a series of bullish candles denoting buying pressure in the market, a large bearish candle appears to signal that the gap created by buyers is not as reliable as it seems. The trigger for the short trade occurs at the open of the next candle, with a stop loss above the highest high in the pattern, and the target around 3 times as large as the stop loss. Bullish breakaway. The bullish breakaway works as a bullish reversal in theory and in practice. This is a rare pattern composed by 5 candles. The first must be a large bearish candle. The second must also be bearish, and it must open with a gap in relation to the first candle. Even though it must open with a gap, the shadows of the first 2 candles are allowed to overlap. The third candle can be bullish or bearish, but it must produce a lower close in relation to the second candle. The fourth candle must be bearish and produce a lower close than the previous candle. And finally, the fifth candle must be a large bullish candle that closes within the gap produced between the bodies of the first 2 candles in the pattern. Even though there are a lot of requirements of identification, the logic behind this pattern is simple. There are 2 main factors: the gap and the final bullish candle. It's precisely the fact that the bullish candle violates the gap territory that makes this a bullish reversal pattern. In other words, after the gap and a series of bearish candles denoting selling pressure in the market, a large bullish candle appears to signal that the gap created by sellers is not as reliable as it seems. The trigger for the long trade occurs at the open of the next candle with a stop loss below the lowest low in the pattern, and the target around 3 times as large as the stop loss. Concealing baby swallow. The concealing baby swallow pattern is considered to be a bullish reversal in theory, but in practice it works as a bearish continuation. This pattern is composed of 4 candles. The first 2 are bearish candles without shadows. The third is a bearish candle with a prominent upper shadow that opens with a gap down and trades within the body of the previous candle. The fourth is a bearish candle that engulfs the third one. It's difficult to see why the theory of this candle pattern suggests a bullish reversal, because the pattern is filled with signs of bearish power. There are only bearish candles, downward gaps, and bearish engulfing candles. This is a bearish continue pattern in practice, so it can serve as a sign to continue in a pre-existing short trade, for example. Dark cloud cover. The dark cloud cover works as a bearish reversal in theory and in practice. There are two candles in this pattern. The first is bullish with medium to large body, and the second is a candle that opens above the prior high, meaning with a gap, and it closes below the midpoint of the previous candle's body. In other words, the second candle is necessarily bearish. The dark cloud cover is a classic example of the sudden appearance of selling pressure after buyers attempt to push the market higher. Notice that the first half of the pattern is bullish, a bullish body followed by a gap up. The second half is what disproves the first half. Price not only closes that gap, but it closes below the midpoint of the first candle, therefore disconfirming the action of buyers. The name of the pattern alludes to the fact that the second bearish candle covers the first bullish candle like a dark cloud covering the sunlight. Trading the dark cloud cover is very simple. The trigger for the short trade occurs at the open of the next candle. The stop loss is above the highest high in the pattern, and the target must be around 3 times larger than the stop. Deliberation. The deliberation pattern works as a bearish reversal in theory, but as a bullish continuation in practice. This pattern is formed by 3 candles. The first 2 are medium to large bullish candles, and the third is a small bullish candle. The third bullish candle being small gives the impression that price is decelerating, and that's why this pattern is considered as a bearish reversal in theory. However, in practice, this is not enough to signal a bearish reversal, so the pattern works as a bullish continuation most of the time. This is a bullish continuation pattern in practice, so it can serve as a sign to continue in a pre-existing long trade. Dragonfly Doji. The Dragonfly Doji can mean indecision, but it can also imply bullish pressure depending on the context. This pattern is composed of only one candle. It opens and closes at or very close to the high of the period, displaying a prominent lower shadow. The Dragonfly Doji implies indecision because of the absence of body. If price opens and closes at the same price, there is no clear winner between buyers and sellers. However, the prominent lower shadow also means that price has traded down at some point and encountered some buyers that made it go up again. That's why it can mean a bullish reversal in certain contexts. If the Dragonfly Doji is implying indecision, there is no trade to be taken. Situation where the Dragonfly Doji implies bullish pressure must be analyzed individually to assess the potential for trade setups. Gapping down Doji. The gapping down Doji works as a bearish continuation in theory, but it works as a bullish reversal slightly more often in practice. The gapping down Doji is formed by a regular Doji, meaning a candle that opens and closes at the same price in the middle of its range. The only difference is that in the gapping down Doji, the upper shadow of the Doji gaps below the lower shadow of the previous candle. The theory behind the gapping down Doji suggests that a Doji after a gap down is a sign of bearish power. However, in reality, this pattern works slightly more often as a bullish reversal. One potential reason for that is that the Doji, which is a sign of indecision, happening after a gap down, demonstrates that sellers don't have enough power to continue their trajectory to the downside. Trading the gapping down Doji is not a great idea because it acts almost like a random pattern in real markets. It's supposed to work as a bearish continuation, but it works as a bullish reversal slightly more often. Gapping up Doji. The gapping up Doji works as a bullish continuation in theory, but it works as a bearish reversal slightly more often in practice. The gapping up Doji is formed by a regular Doji, meaning a candle that opens and closes at the same price in the middle of its range. The only difference is that in the gapping up Doji, the lower shadow of the Doji gaps above the upper shadow of the previous candle. The theory behind the gapping up Doji suggests that a Doji after a gap up is a sign of bullish power. However, in reality, this pattern works slightly more often as a bearish reversal. One potential reason for that is that a Doji, which is a sign of indecision, happening after a gap up, demonstrates that buyers don't have enough power to continue their trajectory to the upside. Trading the gapping up doji is not a great idea because it acts almost like a random pattern in real markets. It's supposed to work as a bullish continuation, but it works as a bearish reversal slightly more often. Gravestone doji. The gravestone doji can mean indecision, but it can also imply bearish pressure depending on the context. This pattern is composed by only one candle. It opens and closes at or very close to the low of the period while displaying a prominent upper shadow. The gravestone doji implies indecision because of the absence of body. If price opens and closes at the same price, there is no clear winner between buyers and sellers. However, the prominent upper shadow also means that price has traded up at some point and encountered some sellers that made it go down again. That's why it can mean bearish pressure in certain contexts. If the gravestone doji is implying indecision, there is no trade to be taken. Situations where the gravestone doji implies bearish pressure must be analyzed individually to assess the potential for trade setups. Long-legged doji. The long-legged doji simply means indecision. The long-legged doji is formed by one candle that opens and closes at the same price in the middle of the candle range. There are symmetrical and prominent shadows. The long-legged doji implies indecision in two different ways. First, the absence of candle body means that there is no clear winner between buyers and sellers in that period. Second, the prominent and symmetrical shadows mean that buyers and sellers have been equally powerful during the formation of the candle. Since this pattern implies indecision, there is no trade to be taken. Northern doji. Some sources regard the northern doji as a bearish reversal pattern, but in reality, it represents indecision, which is not enough to signal a reversal. The pattern is formed by one small candle that opens and closes at the same price after an upward price movement. The northern doji implies indecision because price stalls, but that's not enough to signal a reversal. Evidence that this is true is the fact that price continues to the upside around 50% of the time after the northern doji. Since this pattern implies indecision, there is no trade to be taken. Southern doji. Some sources regard the southern doji as a bullish reversal pattern, but in reality, it represents indecision, which is not enough to signal a reversal. The pattern is formed by one small candle that opens and closes at the same price after a downward price movement. The southern doji implies indecision because price stalls, but that's not enough to signal a reversal. Evidence that this is true is the fact that price continues to the downside around 50% of the time after the southern doji. Since this pattern implies indecision, there is no trade to be taken. Bearish doji star. The bearish doji star is a pattern that works as a bearish reversal in theory, but as a bullish continuation in practice. The pattern is formed by two candles. The first is a large bullish candle, and the second is a small doji that opens with a gap up. The bearish doji star is considered to be a bearish reversal pattern in theory because a doji after a gap up implies that the upward pressure from buyers is not as strong as it seems. In reality though, this pattern signals a continuation to the upside in most cases because a doji is not a signal strong enough to stop the momentum from the large candle and the gap up. The bearish doji star works as a bullish continuation most of the time, but since there is no clear and logical place to put a stop-loss order, it's not optimal to trigger trades. However, it can be used as a sign that you could continue in a pre-existing long trade. Bullish doji star. The bullish doji star is a pattern that works as a bullish reversal in theory, but as a bearish continuation in practice. The pattern is formed by two candles. The first is a large bearish candle, and the second is a small doji that opens with a gap down. The bullish doji star is considered to be a bullish reversal pattern in theory because a doji after a gap down implies that the downward pressure from sellers is not as strong as it seems. In reality though, this pattern signals a continuation to the downside in most cases because the doji is not a signal strong enough to stop the momentum from the large bearish candle and the gap down. The bullish doji star works as a bearish continuation most of the time, but since there is no clear and logical place to put a stop-loss order, it's not optimal to trigger trades. However, it can be used as a sign that you could continue in a pre-existing short trade. Collapsing doji star. The collapsing doji star works as a bearish reversal pattern in theory and in practice. This is a pattern composed by three candles. The first is a bullish candle, the second is a doji that gaps completely below the first candle, and the third is a bearish candle that gaps completely below the doji. This pattern implies a dramatic change in the market. Notice that when a doji gaps below a bullish candle, the sellers have already appeared with a lot of power. The doji in this case is not so much a sign of indecision, but a sign of rest. In the third candle, sellers appear again to confirm their power. A short trade can be triggered at the open of the next candle with a stop above the first candle in the pattern, and the target around 3 times larger than the stop. Downside Gap 3 Methods. The Downside Gap 3 Methods pattern works as a bearish continuation in theory and as a bullish reversal in practice. This pattern is composed of 3 candles. The first is a large bearish candle. The second is another large bearish candle that opens with a gap down. The third is a bullish candle that opens with a gap up roughly in the middle of the second candle and closes within the body of the first candle, therefore filling the gap. In theory, the bullish candle simply closes the gap that was created by sellers. It's a correction in some sense, therefore it's supposed to be a bearish continuation pattern in theory. In reality, however, this pattern works more often as a bullish reversal. Again, the empirical evidence is more important than the theory in these cases. The fact that the third bullish candle opens with a gap up and completely fills the gap down is a sign of emerging bullish power. Recall once again that this evidence is based on the sample used in Bukowski's work. A long trade can be triggered at the open of the next candle with a stop below the lowest point in the pattern and a target 3 times larger than the stop. Downside Tsuki Gap. The downside Tsuki gap works as a bearish continuation in theory. In practice, this is true only around 50% of the time. The downside Tsuki gap is a pattern with 3 candles. The first is a bearish candle. The second is a bearish candle that opens with a gap down. Ideally, there should be no overlap between the shadows. The third candle is bullish and it opens within the body of the second candle and closes within the gap, but it doesn't fill the gap completely. There are 2 important points in this pattern. The first is that sellers can produce a gap down, and the second is that buyers are unable to fill this gap. The combination of these 2 things is what renders this a bearish continuation pattern, although it only really works as a bearish continuation around 50% of the time according to Bukowski's work. Trading the downside Tsuki gap is tricky because there is usually no logical place to put a stop loss, and depending on what happens right after the pattern, this formation can be easily justified as a bullish signal. Bearish engulfing. The bearish engulfing works as a bearish reversal pattern in theory and in practice. The first candle is bullish and the second candle is bearish, but the body of the second candle must engulf the body of the first candle. That usually means that the range of the second candle will also engulf the range of the first one. This pattern implies the market changes from being dominated by buyers to being dominated by sellers, and beyond that, there is an increase in volatility in the second candle, which adds strength to the signal. A short trade can be triggered at the next candle with a stop above the highest point in the pattern. The target should be 3 times larger than the stop. Bullish engulfing. The bullish engulfing works as a bullish reversal pattern in theory and in practice. The first candle is bearish and the second candle is bullish, but the body of the second candle must engulf the body of the first candle. That usually means that the range of the second candle will also engulf the range of the first one. This pattern implies the market changes from being dominated by sellers to being dominated by buyers, and beyond that, there is an increase in volatility in the second candle, which adds strength to the signal. A long trade can be triggered at the next candle with a stop below the lowest point in the pattern. The target should be 3 times larger than the stop. Evening Doji Star. The evening Doji Star works as a bearish reversal in theory and in practice. This pattern is formed by 3 candles. The first one is a medium to large bullish candle. The second is a small doji that opens with a gap up. The shadows are not important in this case. It's important that the doji body gaps in relation to the previous and next candle. The third candle is a medium to large bearish candle that opens with a gap down. The logic here is similar to other patterns that involve gaps and dojis. The first candle implies that buyers are strong, and the gap up confirms that in a way. However, the doji formation means that buyers were not able to confirm the gap up. That opens a window of opportunity for sellers to engage, which is exactly what happens next. Price opens with a gap down and sellers produce a strong candle. A short position can be opened at the next candle with a stop above the high of the doji. The target should be 3 times larger than the stop. Evening star. The evening star works as a bearish reversal in theory and in practice. This is very similar to the evening doji star. The difference is that instead of a doji, the middle candle can have a small body that is either bullish or bearish. The logic here is also quite similar to the evening doji star. The reality is that a doji and a candle with a very small body are almost the same thing, so the two patterns work in the same way. A short position can be opened at the next candle with a stop above the high of the middle candle. The target should be 3 times larger than the stop. Falling 3 methods. The falling 3 methods pattern works as a bearish continuation in theory and in practice. This is a pattern formed by 5 candles. The first one is large and bearish. The following 3 candles are small and bullish with the exception of the middle one, which can be either bullish or bearish. The 5th candle is large and bearish, and it must close below the close of the first candle. The main thing about the falling 3 methods pattern is that it is a failure of price to move significantly to the upside. In other words, buyers fail to break the high of the first bearish move. A short trade can be triggered at the open of the next candle, and the stop can be placed above the highest high among the last 4 candles in the pattern. Notice that a small high is formed by the falling 3 methods pattern. The target should be 3 times larger than the stop. Hammer. The hammer works as a bullish reversal in theory and in practice. The hammer is usually a medium-sized candle that has a small body and a lower shadow that is 2 to 3 times the size of the body. It doesn't matter that much if the candle is bullish or bearish because its meaning comes from the lower shadow. The lower shadow of the hammer implies that the market was going down and encountered some sort of support that made price close in the upper range of the candle. It's a classic sign of buying pressure. A trade can be triggered at the open of the next candle with a stop below the low of the hammer. The target should be 3 times larger than the stop. Inverted hammer. The inverted hammer is supposed to work as a bullish reversal in theory, but it works as a bearish continuation in practice. The inverted hammer is usually a medium-sized candle that has a small body and an upper shadow that is 2 to 3 times the size of this body. It doesn't matter that much if the candle is bullish or bearish because its meaning comes from the upper shadow. The upper shadow of the inverted hammer implies that buyers encountered some sort of resistance that made price close in the lower range of the candle. It's a classic sign of selling pressure. From a logical point of view, there is no reason to consider the inverted hammer a bullish signal. Trading the inverted hammer for its real function of bearish continuation is tricky because there is no logical place to put a stop loss. It can serve as a sign that you could continue in a pre-existing short trade. Hanging man. The hanging man works as a bearish reversal in theory, but it works as a bullish continuation in practice. The hanging man is exactly the same as a hammer, but it appears when price is going up. The logic of the hanging man is the mirror image of the inverted hammer. The difference is that the former appears when price is going up, and the latter appears when price is going down. The lower shadow of the hanging man simply means bullish pressure. A sign of bullish pressure when price is going up is simply a sign of continuation to the upside. Trading the hanging man for its real function in the market is tricky for the same reason trading the inverted hammer is tricky. There is no solid place to put a stop loss. It can be used as a sign that you should remain in a pre-existing long trade. Bearish harami. In theory, the bearish harami is supposed to be a bearish reversal pattern, but empirical evidence shows that half the time it works as a bullish continuation, so it's pretty much a random pattern. The bearish harami is composed by two candles. The first is a bullish candle and the second is a bearish candle whose range is fully contained within the range of the first candle. In practice, a harami is not bullish nor bearish. It simply implies the market has stopped advancing. This can mean a reversal or a continuation depending on the context. By itself, the bearish harami is not strong enough to signal a short trade. Trading the harami pattern depends on other factors, so there is no trade to be taken based on the harami alone. Bullish harami. The bullish harami is a bullish reversal pattern in theory, but in practice it works as a random pattern. The bullish harami is composed by two candles. The first is a bearish candle and the second is a bullish candle whose range is fully contained within the range of the first candle. A harami is not bullish nor bearish. It implies that the market has stopped advancing. This can mean a reversal or a continuation depending on the context. Trading the harami pattern depends on other factors, so there is no trade to be taken based on the harami alone. Bearish harami cross. The bearish harami cross works as a bearish reversal in theory. In practice, it works as a bullish continuation slightly more often than half the time, meaning that it's close to being random. The bearish harami cross is composed by two candles. The first is a bullish candle, and the second is a doji whose range is fully contained within the range of the first candle. The difference between a harami and a harami cross is the doji. The bearish harami cross is an even less powerful bearish signal because it has an inside doji. That's why it ends up working as a bullish continuation a little over half the time. Since the bearish harami cross ends up working as a bullish continuation in practice a little over half the time, it can serve as a sign to continue in a pre-existing long trade. Bullish harami cross. The bullish harami cross works as a bullish reversal in theory. In practice, it works as a bearish continuation slightly more often than half the time, meaning that it's close to being random. The bullish harami cross is composed by two candles. The first is a bearish candle and the second is a doji whose range is fully contained within the range of the first candle. The difference between a harami and a harami cross is the doji. The reason a bullish harami signals a bullish reversal in theory is the inside bullish candle, and even with that, the signal is not strong enough to signal a bullish reversal. The bullish harami cross is an even less powerful bullish signal because it has an inside doji. That's why it ends up working as a bearish continuation a little over half the time. The bullish harami cross can serve as a sign to continue in a pre-existing short trade. High wave. The high wave means indecision in theory and in practice. The high wave is the high volatility version of a spinning top or bottom formation. It's represented by a candle with wide range and very small body in the middle that can be either bullish or bearish. This pattern implies indecision because there is no clear winner in the battle between buyers and sellers throughout the creation of the candle due to the small center body. There is no trade to be taken with this pattern since it just implies indecision in the market. Homing pigeon. The homing pigeon pattern works as a bullish reversal in theory, but as a bearish continuation in practice. The homing pigeon is the same pattern as the bullish harami. The only difference is that the second candle is bearish instead of bullish. In practice, the homing pigeon means that the market has taken a momentary stop, but selling pressure is still present due to the inside bearish candle. There is no trade to be taken with this pattern because there is no clear place to put a logical stop loss order. The homing pigeon can work as a sign that you could continue in a pre-existing short trade. Identical three crows. The identical three crows pattern works as a bearish reversal in theory and in practice. The identical three crows pattern is formed by three equal, or at least very similar, large bearish candles. This pattern implies the emergence of orderly bearish pressure after a bullish trend, so it's a clear sign of reversal. A short trade can be triggered at the open of the next candle with a stop above the first crow. The target should be 3 times larger than the stop. One potential problem with this pattern is that if the crows are too big, the trader will get in the market too far away from the market high. And that's not good because the target will become less likely to be hit and the stop loss will be too large. In-neck. The in-neck pattern works as a bearish continuation in theory and in practice. This pattern is formed by 2 candles. The first one is medium-sized to large and bearish, and the second one opens with a gap down, but it fills the gap by closing at the close of the first candle, therefore generating a bullish candle. The gap down implies bearish pressure, and the second bullish candle doesn't imply bullish pressure. It represents a retracement or a return to balance due to the gap down. Overall, selling power is still larger than buying power because of the larger bearish candle and the gap down. There is no logical place to put a stop loss order in the in-neck pattern, so it serves more as a sign that you could continue in a pre-existing short trade, assuming there was one. Bearish kicking. The bearish kicking pattern works as a bearish reversal in theory. In practice, it can work as a bearish reversal in bull markets or a bearish continuation in bear markets. This pattern is formed by 2 candles. The first is a bullish candle with no shadows, and the second is a bearish candle with no shadows that opens with a prominent gap down. The absence of shadows represents certainty of the movement. The significant gap down and the certainty of the second candle override the certainty of the first candle, therefore creating the representation of bearish power. A short trade can be triggered at the open of the next candle with a stop above the high of the first candle, with a target 3 times larger than the stop. Bullish kicking. The bullish kicking works as a bullish reversal in theory. In practice, it works as a bullish reversal or bullish continuation depending on the preceding price action. This pattern is formed by 2 candles. The first is a bearish candle with no shadows, and the second is a bullish candle with no shadows that opens with a prominent gap up. The absence of shadows represents certainty of the movement. The significant gap up and the certainty of the second candle override the certainty of the first candle, therefore creating the representation of bullish power. A long trade can be triggered at the open of the next candle with a stop below the low of the first candle, with a target 3 times larger than the stop. Ladder bottom. The ladder bottom pattern works as a bullish reversal in theory. In practice, it's a random pattern. This pattern is composed of 5 candles. The first 3 are bearish candles with decisive bodies. The fourth is a bearish candle with a more prominent upper shadow, and the fifth candle is a bullish candle gapping above the body of the fourth candle. The appearance of a gapping up bullish candle after a series of bearish candles implies bullish power according to the theory. In reality, the bullish candle is not strong enough to signal a bullish reversal a lot of the times, so that's why this pattern only works as a bullish reversal around 50% of the time. There is no trade to be taken based on this pattern since empirical evidence suggests that it's random. Last engulfing bottom. The last engulfing bottom works as a bullish reversal in theory. In practice, it works as a bearish continuation. This pattern is made of 2 candles. The first is a bullish candle and the second is a bearish candle whose body engulfs the body of the first candle. One potential point of confusion here is that this pattern is similar to the bearish engulfing. The difference is that the bearish engulfing appears in an upward price movement, while the last engulfing bottom appears in a downward price movement. The reason why this is considered a bullish reversal in theory is because the bearish candle can be interpreted as an exhaustion. In practice, the bearish engulfing candle is a sign that there is still momentum to the downside, and that's why this pattern signals a bearish continuation most of the time. A short trade can be triggered at the open of the next candle with a stop above the high of the bearish candle and a target 3 times larger than the stop. Last engulfing top. The last engulfing top works as a bearish reversal in theory. In practice, it works as a bullish continuation. This pattern is made of 2 candles. The first is a bearish candle and the second is a bullish candle whose body engulfs the body of the first candle. One potential point of confusion here is that this pattern is similar to the bullish engulfing. The difference is that the bullish engulfing appears in a downward price movement, while the last engulfing top appears in an upward price movement. In practice, the bullish engulfing candle is a sign that there is still momentum to the upside. That's why this pattern signals a bullish continuation. A trade can be triggered at the top of the next candle with a stop below the low of the bullish candle and a target 3 times larger than the stop. Bearish Marubozu. The bearish Marubozu works as a bearish continuation in theory and in practice, but only slightly more than 50% of the time. The bearish Marubozu is simply a large bearish candle with no shadows. The reason this pattern implies a bearish continuation is that the absence of candle shadows implies certainty to some degree. So a large bearish candle without any shadows represents bearish certainty. One potential problem here is that a large candle sometimes means exhaustion of the dominant market player. That's probably the reason why this is not a stronger continuation pattern. Since the Marubozu is a continuation pattern that has high volatility, it's often not a good place for triggering trades because the trader will enter the market too far away from a logical stop-loss placement. Bullish Marubozu. The bullish Marubozu works as a bullish continuation in theory and in practice, but only slightly higher than 50% of the time. The bullish Marubozu is simply a large bullish candle with no shadows. The reason this pattern implies a bullish continuation is that the absence of candle shadows implies certainty to some degree. So a large bullish candle without any shadows represents bullish certainty. Similarly to the bearish Marubozu, this pattern can also mean exhaustion from buyers sometimes. Since the Marubozu is a continuation pattern that has high volatility, it's often not a good place for triggering trades because the trader will enter the market too far away from a logical stop-loss placement. Mat hold. The mat hold works as a bullish continuation in theory and in practice. This formation is composed of 5 candles. The first is a strong bullish candle. The second is a small bearish candle that opens with a gap up and closes above the close of the previous period. The third candle can be either bullish or bearish. The fourth candle must be bearish, and it must close above the low of the first period in the formation. The fifth and final candle is a strong bullish candle that closes above the highs of all the previous candles in the formation. The mat hold implies bullish power in several aspects when we look at its general form. First, we have the strong bullish candles at the beginning and end. Second, we have one gap up. And third, we have the fact that buyers can advance in one candle what sellers take 3 to do. So there's a sense that sellers have difficulty moving and buyers are free to go. A long position can be triggered at the open of the next candle with a stop below the minor low that forms within the pattern and a target 3 times larger than the stop. Matching low pattern. The matching low pattern works as a bullish reversal in theory, but as a bearish continuation in practice. This pattern is formed by 2 bearish candles. The second candle opens with a gap up, and its low matches the low of the first candle in the pattern. The reason why this pattern is considered a bullish reversal signal is because the matching lows of the 2 candles suggest that price is hitting a support level. However, the empirical evidence shows that this support is not strong enough to hold price most of the time. So this pattern tends to work more as a bearish continuation signal. Since this is a continuation pattern in reality, it can serve to signal you could continue in a pre-existing short trade. Bearish meeting lines. The bearish meeting lines pattern works as a bearish reversal in theory. In practice, it works as a bearish reversal half the time and as a bullish continuation the other half, so it's a random pattern. This pattern is formed by 2 candles. The first is a strong bullish candle and the second is a strong bearish candle that opens with a gap up and closes at the previous candle's close. The second candle opens with a significant gap up, which means bullish pressure, but it closes at the previous candle's close, which means bearish pressure in the same amount of the bullish pressure that created the gap up. In other words, buyers show up and sellers react in the same amount. It's not recommended to trade solely based on the bearish meeting line because of its randomness. Bullish meeting lines. The bullish meeting lines pattern works as a bullish reversal in theory. In practice, it works as a bullish reversal half the time and as a bearish continuation the other half, so it's a random pattern. This pattern is formed by two candles. The first is a strong bearish candle, and the second is a strong bullish candle that opens with a gap down and closes at the previous candle's close. The second candle opens with a significant gap down, which means bearish pressure, but it closes at the previous candle's close, which means buying pressure in the same amount of the previous bearish pressure. In other words, sellers show up and buyers react in the same amount. It's not recommended to trade solely based on the bearish meeting lines because of its randomness. Morning Doji Star. The morning doji star works as a bullish reversal in theory and in practice. This pattern is formed by three candles. The first one is a medium to large bearish candle. The second is a small doji that opens in a gap down. The shadows are not important in this case. It's important that the doji gaps in relation to the previous and next candle. The third candle is a medium to large bullish candle that opens with a gap up. The logic here is similar to other patterns that involve gaps and dojis. The first candle implies that sellers are strong, and the gap down confirms that in a way. However, the doji formation means that sellers were not able to confirm the gap down. That opens a window of opportunity for buyers to engage, which is exactly what happens next. Price opens with a gap up and buyers produce a strong candle. In other words, there is a smooth transition from bearish power to bullish power. A long position can be opened at the next candle with a stop below the low of the doji. The target should be 3 times larger than the stop. Morning Star. The morning star pattern works as a bullish reversal in theory and in practice. This is very similar to the morning doji star. The difference is that instead of a doji, the middle candle can have a small body that is either bullish or bearish. The logic here is also quite similar to the morning doji star. The reality is that a doji and a candle with a very small body are almost the same thing, so the two patterns work in the same way. A long position can be opened at the next candle with a stop below the low of the pattern. The target should be 3 times larger than the stop. On neck. The on neck pattern works as a bearish continuation in theory and in practice, but only slightly above 50% of the time. This pattern is formed by two candles. The first is bearish and the second is a bullish candle that opens with a gap down and closes at the prior low. Price produces a bearish candle and then a gap down, implying bearish pressure. Buyers try to counteract that, and they are capable of matching the previous low, but they cannot close the gap between bodies, which is another sign of bearish pressure. In reality, the pattern is slightly more bearish than bullish, so the outcome is close to randomness. It's not advisable to trade based only on the on-neck pattern because its outcome is close to random. In other words, the pattern is only slightly more bearish than bullish. Piercing line. The piercing line works as a bullish reversal in theory and in practice. This pattern is composed of two candles. The first one is bearish. The second opens with a gap down and closes above the midpoint of the first candle. Therefore, the second candle is bullish. This pattern implies a bullish reversal because despite the appearance of the first bearish candle and the gap down, price closes in the upper half of the first candle after filling the gap down, which is a strong sign of bullish power. A long trade can be triggered at the open of the next candle with a stop below the lowest point in the pattern. The target must be 3 times larger than the stop. Rising 3 methods. The rising 3 methods pattern works as a bullish continuation in theory and in practice. This is a pattern formed by 5 candles and it's very similar to the mat hold. The first one is large and bullish. The following 3 candles are small and bearish with the exception of the middle one, which can be either bullish or bearish. The 5th candle is large and bullish, and it must close above the close of the first candle. The main thing about the rising 3 methods is that it's a failure of price to move significantly to the downside. In other words, sellers fail to break the low of the first bullish move. The 5th candle in the pattern is a statement that those sellers have given up trying and buyers resumed control of the market. A long position can be triggered at the open of the next candle, and the stop can be placed below the minor low that is usually formed in the pattern. The target should be 3 times larger than the stop. Bearish separating lines. The bearish separating lines pattern works as a bearish continuation in theory and in practice. This pattern is formed by 2 candles. The first one is bullish and the second one is bearish, with the exception that it opens with a significant gap down near the open of the first candle. The bearish signal comes from the dramatic gap down and the fact that price continues to go down after the gap. All of that happening after a bullish candle implies that sellers have taken control. A short trade can be triggered at the open of the next candle with a stop above the high of the first candle, and the target must be 3 times larger than the stop. Bullish separating lines. The bullish separating lines pattern works as a bullish continuation in theory and in practice. This pattern is formed by 2 candles. The first one is bearish and the second one is bullish, with the exception that it opens with a significant gap up near the open of the first candle. The bullish signal comes from the dramatic gap up and the fact that price continues to go up after the gap. All of that happening after a bearish candle implies that buyers have really taken control. A long trade can be triggered at the open of the next candle with a stop below the low of the first candle, and the target must be 3 times larger than the stop. Shooting star. The shooting star works as a bearish reversal in theory and in practice. Ideally, this is a bearish candle with a small body and a very prominent upper shadow and no lower shadow. A small bullish body and a very small lower shadow can be tolerated though, but it's not ideal. This is a very simple pattern. The bearish pressure comes from the prominent upper shadow. If the surrounding context of price action supports the idea, a short trade position can be triggered at the open of the next candle with a stop above the high of the shooting star and a target 3 times larger than the stop. 2 candle shooting star. The 2 candle shooting star works as a bearish reversal in theory, but as a bullish continuation in practice slightly more often than half the time. This pattern is formed by 2 candles. One wide range bullish candle followed by a shooting star, which is a medium-sized candle either bullish or bearish that has a small body and a prominent upper shadow. When the shooting star is preceded by a high volatility bullish candle, the shooting star pattern loses its capacity to signal a bearish reversal because there is too much momentum to the upside. The 2 candle shooting star is a bullish continuation pattern most of the time, so it can be used as a signal to continue in a pre-existing long trade. Bearish side-by-side white lines. The bearish side-by-side white lines is a bearish continuation pattern in theory and in practice, but only slightly over 50% of the time. This pattern is formed by 3 candles. The first is a bearish candle. The second and third candles are bullish, but they have opening prices that are very similar, and both close below the body of the first candle, which also means that there is an unfilled gap between the first candle and the rest of the pattern. The secret to understand this pattern lies in the fact that the 2 final candles open roughly at the same price and close below the body of the first candle. This implies that buyers are trying to make prices rise, but they are failing to do so, therefore signaling a bearish continuation. Triggering trades with this pattern is not ideal since there is no logical place to put a stop loss. This pattern can be used to signal the continuation of a pre-existing short trade, for example. Bullish side-by-side white lines. The bullish side-by-side white lines pattern works as a bullish continuation in theory and in practice. This pattern is formed by 3 candles. The first is a bullish candle. The second and third candles are also bullish, but they have opening prices that are very similar, and both open and close above the body of the first candle, forming an unfilled gap up. Despite the dominant presence of bullish candles, the fact that the last 2 candles open roughly in the same price implies some bearish pressure. However, this bearish pressure is not enough to make price go down substantially or signal a bearish reversal. Since this is a continuation pattern, it doesn't serve well as a trigger, but it can be used as a sign that the trader could remain in a pre-existing long trade. Spinning top. The spinning top represents indecision. That means price will continue to the upside around half the time and reverse to the downside around half the time. This is a pattern formed by one candle that has a small body and symmetrical shadows that are larger than the body. The candle can be either bullish or bearish. The key here is to understand that symmetrical shadows imply the same degree of bullish and bearish power. Therefore, the spinning top implies indecision. When shadows are more prominent than the candle body, they become more important in a way. There is no trade to be taken with the spinning top since it's a sign of indecision. Spinning bottom. The difference between a spinning top and a spinning bottom is the price action that precedes it. The term bottom implies that the pattern will signal a reversal, but that's just a naming convention. The pattern will signal a continuation around half the time. This is a pattern formed by one candle that has a small body and symmetrical shadows that are larger than the body. The candle can be either bullish or bearish. The key here is to understand that symmetrical shadows imply the same degree of bullish and bearish power. Therefore, the spinning bottom implies indecision. There is no trade to be taken with the spinning bottom since it's a sign of indecision. Stick sandwich. The stick sandwich pattern works as a bullish reversal in theory, but as a bearish continuation in practice. This pattern is formed by three candles. The first is a bearish candle. The second is a bullish candle that trades above the close of the first candle in some way. And the third is a bearish candle that closes near or at the close of the first candle. The logic behind this pattern is that price is hitting some sort of support while trying to go higher. In reality, this attempt to go higher is not enough to signal a reversal to the upside. That's why the empirical evidence shows that this pattern works as a bearish continuation more often. This is a continuation pattern, so it serves to signal that you can continue in a pre-existing short trade. Takuri line. The Takuri line works as a bullish reversal in theory and in practice. The Takuri line is exactly like a hammer, but with a longer lower shadow. The color of the small body is not as relevant as the size of the lower shadow. The very prominent lower shadow means that price reacted to some sort of support that made the candle close in its upper range, a classic sign of bullish pressure. A long trade can be triggered at the open of the next candle with a stop below the low of the Takuri line, and the target must be 3 times larger than the stop. 3 black rows. The 3 black rows pattern works as a bearish reversal in theory and in practice. This pattern is composed of 3 bearish candles with medium to large bodies. Ideally, the second and third candles should open within the body of the previous candle, but in my view, that's unnecessary. The consecutive bearish candles with medium bodies represent a classic sign of selling pressure. The 3 black rows pattern is very simple to detect and understand, but it has a caveat. The pattern sometimes can be a trend in itself, which means that trading it can be difficult because the logical stop-loss placement may be too far away from the entry. In any case, the trigger can occur at the open of the next candle, and the stop must be above the highest point of the pattern with a target 3 times larger than the stop. The trader must assess if there is leeway for price to reach the target with the appropriate risk-reward ratio. 3 inside down. The 3 inside down pattern works as a bearish reversal in theory and in practice. This pattern is exactly like a bearish harami, but with an additional bearish candle that closes lower than the harami. A harami pattern implies that price has stopped advancing. If the next candle closes lower, then there is the indication or perhaps the confirmation that price will reverse. It's a safer pattern than the harami because of that. A short position can be triggered at the open of the next candle with a stop above the highest high in the pattern and a target 3 times larger than the stop. 3 inside up. The 3 inside up pattern works as a bullish reversal in theory and in practice. This pattern is exactly like a bullish harami, but with an additional bullish candle that closes above the harami. A harami pattern implies that price has stopped advancing. If the next candle closes higher, then there is the indication or perhaps the confirmation that price will reverse. It's a safer pattern than the harami because of that. A long position can be triggered at the open of the next candle with a stop below the lowest low in the pattern and a target 3 times larger than the stop. Bearish three-line strike. The bearish three-line strike is known as a bearish continuation pattern, but it works as a bullish reversal in practice. This pattern is formed by 4 candles. The first 3 are bearish candles, and the fourth is a bullish candle that opens with a small gap down and closes above the open of the first candle. This pattern is considered to be a signal of bearish continuation in theory because the large bullish candle is seen as a pullback of the downward price movement created by the first 3 bearish candles. However, in practice, this works as a bullish reversal because one bullish candle has the power to overcome 3 bearish candles. It's a clear sign of bullish power. A long trade can be triggered at the open of the next candle with a stop below the low of the pattern and a target 3 times larger than the stop. One problem here is that since the trigger can be too far away from the stop, price action must travel a great distance in order to hit a decent risk-reward ratio. So once again, the trader must assess if there is leeway for price to do that. Bullish three-line strike. The bullish three-line strike is known as a bullish continuation pattern in theory, but in practice, it works as a bearish reversal. This pattern is formed by 4 candles. The first 3 are bullish candles, and the fourth is a bearish candle that opens with a small gap up and closes below the open of the first candle. This pattern is considered to be a signal of bullish continuation in theory because the large bearish candle is seen as a pullback of the upward price movement created by the first 3 bullish candles. However, in practice, this works as a bearish reversal because one bearish candle has the power to overcome 3 bullish candles. It's a clear sign of bearish power. A short trade can be triggered at the open of the next candle with a stop above the high of the pattern and a target 3 times larger than the stop. One problem here is that since the trigger can be too far away from the stop, price action must travel a great distance in order to hit a decent risk-reward ratio. So once again, the trader must assess if there is enough leeway for price to do that. 3 outside down. The 3 outside down pattern works as a bearish reversal in theory and in practice. This one is similar to the bearish engulfing pattern, but with an extra bearish candle that confirms the pattern. An additional bearish candle after a bearish engulfing candle is a confirmatory maneuver that makes the engulfing pattern less uncertain at the expense of moving the trigger away from the logical stop. A short trade can be triggered at the open of the next candle with a stop above the highest point in the pattern. The target must be 3 times the size of the stop. 3 outside up. The 3 outside up pattern works as a bullish reversal in theory and in practice. This one is similar to the bullish engulfing pattern, but with an extra bullish candle that confirms the pattern. An additional bullish candle after a bullish engulfing candle is a confirmatory maneuver that makes the engulfing pattern less uncertain at the expense of moving the trigger away from the logical stop. A long trade can be triggered at the open of the next candle with a stop below the lowest point in the pattern. The target must be 3 times the size of the stop. 3 stars in the south. The 3 stars in the south pattern works as a bullish reversal in theory and in practice. This pattern is composed of 3 candles. The first is a bearish and with a longer lower shadow. The second is similar to the first one in shape, but it's smaller and the low cannot surpass the first candle's low. The third is a bearish candle with no shadows that is contained within the range of the second candle in the pattern. Despite the apparently complicated identification of the 3 stars in the south, the logic behind it is simple. Bearish candles are progressively smaller and candles fail to produce lower lows as the pattern progresses. This implies bullish power by the failure of sellers. Since the theoretical trigger for this pattern is too close to the stop loss level, it's wise to wait for a confirmatory bullish candle to occur after the pattern, and then enter the trade at the open of the next candle with a stop below the lowest point in the pattern and a target 3 times larger than the stop. 3 white soldiers. The 3 white soldiers pattern works as a bullish reversal in theory and in practice. This pattern is composed of 3 bullish candles with medium to large bodies. Ideally, the second and third candles should open within the body of the previous candle, but in my view, that's unnecessary. Three consecutive bullish candles with decisive bodies is a clear sign of bullish power. The three white soldiers pattern is very simple to detect and understand, but it has a caveat. The pattern sometimes can be a trend in itself, which means that trading it can be difficult because the logical stop-loss placement may be too far away from the trigger. In any case, the trigger can occur at the open of the next candle, and the stop must be below the lowest point of the pattern with the target 3 times larger than the stop. The trader must assess if there is leeway for price to reach the target, as is the case with any other pattern. Thrusting. The thrusting pattern works as a bearish continuation in theory, but as a bullish reversal slightly more often than 50% in practice. This pattern is formed by two candles. The first is a bearish candle, and the second is a bullish candle that opens with a gap down and closes above the close of the first bearish candle. In theory, this pattern is considered to be a bearish continuation signal because of the bearish candle and the gap down. In practice, however, the fact that buyers are able to fill the gap and close higher than the first candle's close makes this pattern work more often as a bullish reversal, but only slightly more often. A long trade can be triggered at the open of the next candle with a stop below the lowest point in the pattern. The target should be 3 times larger than the stop. Bearish Tri-Star. The bearish Tri-Star pattern works as a bearish reversal in theory and in practice. This pattern is composed of 3 candles, 3 consecutive dojis. The middle doji must have a body above the outer dojis. The bearish Tri-Star is defined as a bearish reversal pattern because it implies weakness on the part of buyers. When price fails to advance to the upside for 3 candles in a row, like it does in this pattern, there's a window of opportunity for the sellers to get in. A short trade can be triggered at the open of the next candle with a stop above the highest high in the pattern and a target 3 times larger than the stop. Bullish Tri-Star. The bullish Tri-Star pattern works as a bullish reversal in theory and in practice. This pattern is composed of 3 candles, 3 consecutive dojis. The middle doji must have a body below the outer 2 dojis. The bullish Tri-Star is defined as a bullish reversal pattern because it implies weakness on the part of sellers. When price fails to advance to the downside for 3 candles in a row, like it does in this pattern, there is a window of opportunity for buyers to get in. A long trade can be triggered at the open of the next candle with a stop below the lowest low in the pattern and a target 3 times larger than the stop. Tweezer Bottom. The tweezer bottom works as a bullish reversal signal in theory, but as a random pattern in practice. This pattern is composed of 2 candles, either bullish or bearish, that have the same low. This is seen as a bullish reversal pattern because price is hitting a support level, but in practice, this is not enough to signal a reversal to the upside. Trade scenarios must be analyzed individually to assess proper entry, stop, and target. Tweezer Top. The tweezer top works as a bearish reversal signal in theory, but as a random pattern in practice. This pattern is composed of 2 candles, either bullish or bearish, that have the same high. This is seen as a bearish reversal pattern because price is hitting a resistance level, but in practice, this is not enough to signal a reversal to the downside. Trade scenarios must be analyzed individually to assess proper entry, stop, and target. 2 black gapping candles. The 2 black gapping candles pattern works as a bearish continuation in theory and in practice. This pattern is formed by 2 bearish candles. The first one opens with a gap down. The second one must produce a lower high and lower low. A gap down and consecutive lower highs and lower lows are all signs of bearish power. Trading this pattern is a bit tricky because there is no solid place to put a stop loss, so it serves more as a sign that you could continue in a pre-existing short trade. 2 crows. The 2 crows pattern works as a bearish reversal in theory and in practice, but only slightly more than 50% of the time. This pattern is composed of 3 candles despite its name. The first is a bullish candle. The second is a bearish candle that opens with a gap up. And the third is also a bearish candle, but it closes within the body of the first candle, therefore filling the initial gap up. The bullish candle and the gap up imply bullish pressure in the first moment. The second candle shows sellers reacting to the gap up, and the fact that the third candle closes within the body of the first bullish candle is indication that sellers might be stronger than what they seem, but only slightly stronger than buyers. A short trade can be triggered at the open of the next candle with a stop above the highest point in the pattern and a target 3 times larger than the stop. Unique 3-river bottom. The unique 3-river bottom is a bullish reversal in theory, but in practice, it works as a bearish continuation slightly more often than 50% of the time. This pattern is formed by 3 candles. The first is a medium to large bearish candle. The second is a bearish candle whose body is contained within the body of the first candle, but it also produces a lower shadow than the first one. The third candle must have a small bullish body that sits below the body of the second candle. The prominent lower shadow and the fact that the second candle's body is contained in the body of the first candle is a bullish indication because sellers stopped advancing and price has encountered some sort of support. The third small body bullish candle is just an additional but weak confirmation that buyers are present. In practice, this pattern simply represents a momentary stop in the advancement of price, which is not enough to signal a reversal. Since this pattern works more often as a bearish continuation, there is no trade to be taken. It can work as a signal to continue in a pre-existing short trade. Upside Gap 3 Methods. The Upside Gap 3 Methods pattern works as a bullish continuation in theory and as a bearish reversal in practice. The first 2 candles are bullish, and they have an upward gap separating them. The third candle in the pattern fills the gap and closes within the body of the first bullish candle. Even though the first 2 bullish candles and the upward gap suggest a strong bullish continuation, the third candle frustrates that expectation by filling the gap and closing within the body of the first candle. You can think of it as a fast bearish reversal contained in one candle only. A short trade can be triggered at the open of the next candle with a stop above the highest point in the pattern and a target 3 times larger than the stop. Upside Gap 2 Crows. The Upside Gap 2 Crows pattern works as a bearish reversal in theory and as a bullish continuation in practice. This pattern is composed of 3 candles. The first is a bullish candle. The second is a bearish candle that opens with a gap above the first candle, and the third is another bearish candle that engulfs the second candle but fails to close the upward gap. The theory behind this pattern suggests that it is a bearish reversal because of the engulfing pattern in the last 2 candles. However, the statistics shows us that it works more often as a bullish continuation, so the unfilled gap tends to be a stronger force than the engulfing pattern. Since this is a continuation pattern, there isn't a logical place to put a stop loss order, so this pattern doesn't work as an entry setup, but it can be used as a sign the trader could continue in a pre-existing long trade. Upside Tasuki Gap. This pattern works as a bullish continuation in theory and in practice. The Upside Tasuki Gap is formed by 3 candles. The first is a bullish candle, the second is a smaller bullish candle that opens with a gap up, and the third is a bearish candle that opens within the body of the second candle and partially fills the upward gap between the first and second candles. This is a similar pattern to the Upside Gap 2 Crows, but it's considered as a bullish continuation because there isn't an engulfing pattern. The fact that the upward gap is not totally filled is also evidence for buyers. In practice, it works as a bullish continuation only slightly more often than 50% of the time though. Since this is a continuation pattern, there isn't a logical place to put a stop loss, so this pattern doesn't work as an entry setup, but it can be used as a sign the trader could continue in a pre-existing long trade. Falling Window. The falling window works as a bearish continuation in theory and in practice. This pattern occurs when there is a downward gap between 2 bearish candles. The downward gap is a classic sign of bearish power. This is a pattern that can be used as a sign that the trader could continue in a pre-existing short trade. Rising Window. The rising window works as a bullish continuation in theory and in practice. This pattern occurs when there is an upward gap between 2 candles. The upward gap is a classic sign of bullish power. This is a pattern that can be used as a sign that the trader could continue in a pre-existing long trade. Advantages and disadvantages of candlesticks. It's important to know the advantages of candlesticks, but it's perhaps more important to understand the disadvantages and limitations of this technique. As is the case with any trading technique, candlesticks also have a bad side that must be understood. Let's begin with the advantages, and then we'll move on to the disadvantages and limitations you should be aware of. Number 1. Candlesticks are perhaps the most reliable way of visualizing the evolution of price action over time. It's not a coincidence that this form of charting has become widely popular. It's an intuitive way of observing price action. Number 2. Because of their popularity, candlesticks are subjected to something called the self-fulfilling prophecy effect. In basic terms, when a technique is very popular, people act as if it is true regardless of its scientific validity. That means that candlestick patterns always cause some sort of reaction in the market, and in many instances, this initial reaction will be enough to nudge price into a more significant reversal. This is the good side of the self-fulfilling prophecy effect. There is a bad side to it, as you'll learn in just a moment. Number 3. Candlesticks are very easy to understand, and they can provide an enormous amount of useful information for the educated trader, something that other forms of charting are not capable of. For instance, it's difficult to make any sort of detailed inference about what happened between buyers and sellers inside a given period if you use a simple line chart. Number 4. Another advantage of candlesticks is that they can provide objective places to trigger trades, place stops, and target orders. Number 5. Candlesticks are the fundamental building block of price action reading. Without them, a lot of value would be lost in technical analysis. Number 6. Candlesticks are a form of charting where time is plotted linearly in the x-axis, and what varies is the candlestick itself in the y-axis. Because of this linearity of the x-axis, the geometric overlay indicators like channels, lines, pitchforks, and so on can be plotted in a more realistic way in comparison to other charting methods where time is plotted in the x-axis in a nonlinear way. That's one of the prices to pay for the noise removal quality of price-based charting methods. Let's now observe the disadvantages. Number 1. By far, the biggest disadvantage of candlestick patterns is that there are too many patterns to memorize, which makes the real-time application of this technique difficult. With that said, learning, memorizing, and applying candlestick patterns is not the greatest value we can extract from candlesticks. The value lies in learning how to read any candlestick in any market in any time frame on command, using simple logic instead of memorizing a prepackaged interpretation from a pattern. Another problem with candlestick patterns is that their interpretation can change according to the external forces of the market or the surrounding context of price action. So a pattern might work exactly as it is supposed to in one type of market scenario and fail completely in others. That's why learning patterns is not enough. Broader perspectives of price action that go beyond candlesticks must be considered because of that. Number 3. Even though candlesticks are very useful to extract some types of information about buyers and sellers, there is ambiguity in them as was previously demonstrated. Some of this ambiguity can be removed by looking at lower time frames, but that solution has a caveat. When the trader switches time frames, he dramatically increases the amount of information he must consider in the analysis in a counterproductive way, and that makes the analysis overwhelming. Sticking to one time frame only is already a challenge. Number 4. Even though there are many candlestick patterns, they are far from exhausting the full scope of what candlesticks can do. That means that the complete memorization of these patterns is not only difficult to do, but it makes the trader miss many other things that candlesticks can do. Number 5. The shapes of candlesticks can have a lot of variation and still fall within the same pattern, and that makes this technique harder to use sometimes. There are a lot of ways in which the same pattern can appear in the charts, and that makes it difficult to scan for these patterns. Number 6. The self-fulfilling prophecy effect has a good side, which implies it has a bad side also. The financial market is a mechanism that reacts to predictions about itself. The more famous a tool is, the greater the self-fulfilling prophecy effect, but also the smaller its profitability potential in isolation. That happens precisely because market participants already expect the initial reaction, and they tend to close profits too soon because of the risk-averse behavior that occurs when small profits are lying around, and because traders begin to preempt one another. All of this means that candlesticks by themselves can be used as a nudge to reversals or continuations only when there are other tools indicating that this is going to happen. By themselves, they cannot provide reliable results over time. In fact, any tool in isolation is unreliable. Number 7. The theory of how a candlestick pattern should work often diverges from how it works in real markets. For example, some candle patterns are meant to work as a bullish reversal, but end up working as a bearish continuation. That means there is something wrong, or at least something incomplete about the way these patterns came to be. Number 8. Candlestick patterns are not equally reliable. Beyond the fact that some patterns behave in the opposite way they should, some patterns do behave in the way they should, but just barely. It's also true that only a small set of patterns work as expected, statistically speaking, although assuming that probabilities will continue to be the same in the future of dynamical systems is problematic. Candlestick patterns are extremely popular, but at the same time, the way they came to be and the expectations that traders have in relation to them are filled with incorrect assumptions and flaws. We need a more realistic and robust way of using candlesticks since they are the foundation of price action reading. Frequently asked questions. At this stage in the course, I want to answer a few of the most frequently asked questions I receive about candles. Since I started this channel, I've had the opportunity of talking to a lot of different traders around the world, so I have the data on what concerns these traders the most regarding specific topics. These are the questions I get the most about candlestick patterns and their respective answers. Number 1. What is the best candlestick pattern? It depends on what you mean by best. The pattern that appears more frequently, or the pattern that works most of the time. Those two are not necessarily the same. As was said earlier, a lot of the times, the patterns that show good performance in statistical terms are also rare patterns, which is not very useful. Beyond that, the probabilities associated with patterns change over time, so what used to be a good pattern can turn into an unreliable pattern in the future. Trying to find the best pattern is the wrong way of thinking about this. Traders need a framework to analyze candlesticks in a better way instead of simply memorizing patterns. Number 2. Can I trade only using candlestick patterns? You can, but the results will probably upset you. The role of candlesticks is to provide a foundation for price action reading. Good price action reading in combination with other methods and tools of technical analysis is what is going to allow you to take advantage of high-quality trade opportunities. Using candlesticks alone is not enough to overcome the uncertainty of the markets. Number 3. How many candlestick patterns are there after all? That's easy to answer. Too many. This relates to something that I've said in the past. It's a lot smarter to learn how to interpret any candlestick using logic than it is to memorize dozens of different patterns. Traders underestimate how difficult it is to promptly scan the market for all these patterns simultaneously. That's not realistic at all. Number 4. Are candlestick patterns reliable? The reason you want to learn about candlesticks is not to detect trade opportunities through candle patterns exactly, even though there is certainly a place for that in trading. That's what attracts people to them in the first moment. The real motivation to learn about candlesticks is that they are the main way price action is displayed, and there is a lot of information that can be extracted from them once the trader understands the mechanics and the geometry of candles. Candlesticks are absolutely indispensable if you want to learn price action reading, and price action reading is indispensable if you want to be able to spot high-quality trade opportunities in the market, assuming you trade with price charts. In summary, candlesticks are definitely reliable, but not in the way most traders expect. Number 5. Candlesticks are very famous, so they must be the best technique, right? Candlesticks are very famous for a few different reasons. The first thing a new retail trader sees in a price chart is a series of candlesticks, so the natural path is to learn about them first. Another reason for their popularity is the fact that it's very easy to learn about candlesticks. A third reason is that people are motivated to learn about them when they recognize that there are candlestick patterns that can act like simple trade setups. All of this has absolutely nothing to do with candlesticks being the best trading technique or not. Just because something is famous doesn't mean it's good. It means it's accessible to a lot of people. Beyond that, as we saw in the course, a famous technique is subjected to the self-fulfilling prophecy effect, which has a good side and a bad side. Depending on how you trade, you can take advantage of the positive side, but you can also be a victim of the bad side. Trying to decide what is the best tool in technical analysis is the wrong way of thinking about it. There is no such thing as the best trading technique. There are only good combinations of good trading techniques. Remember that we are dealing with patterns, and patterns are not guarantees. You can find many instances of failure with any trading technique. It's not about a technique, it's about the combination of techniques. Next steps and further learning. In this free course, you gain a lot of insight about the basics of candlesticks and the famous candlestick patterns. You also learn the bad side of the technique, which is rare in any kind of guide you'll find on YouTube. I've always said that there is a lot of benefit in learning the limitations of a trading technique because that leads us to understand the right questions traders should be asking in relation to anything associated with trading. A lot of traders nowadays are looking for the right answer, but for the wrong questions, and that of course is a fool's errand. For example, traders ask what the best trading technique is, but that's the wrong question. The right question is, what are the combinations of techniques that have the greatest chance of yielding a good result? That's just one example. There are countless right and wrong questions in trading. Since now you understood the limitations of candlesticks, especially candlestick patterns, we can start moving in the right direction in order to unlock the true power of candles. Let's briefly summarize the limitations. 1. There are too many patterns to memorize. 2. The interpretation of patterns changes depending on the surrounding elements of price action. 3. There is ambiguity in candlesticks. 4. Despite the existence of too many patterns, these patterns don't fully exhaust all the possibilities of what candles can do. 5. There's a lot of variation in the way the same pattern can appear, and that makes it even more difficult to scan for these patterns in real charts. 6. As you saw earlier, the way candlestick patterns behave in practice goes against the theory of how they should work, which shows that there is something deeply wrong with the theory of candlestick patterns. 7. Candlestick patterns in isolation make traders become a victim of the bad side of the self-fulfilling prophecy effect. 8. The probabilities associated with patterns change over time, so even if you find the best pattern, it can become obsolete in the future. All of this means that we need a better way of thinking about candlesticks, since they are important for any price action trading strategy. Instead of memorizing a bunch of patterns with varying probabilities and faulty theoretical assumptions, we need a framework of analysis that allows us to interpret any candle in any market, in any time frame, on command, using simple logic. This framework of analysis should also deal with all these other limitations associated with the common way of thinking about candlesticks. As you can see, one of the issues of unique domains like trading is that sometimes you find about problems you didn't know you had. Based on the main limitations of candlesticks and the necessity of a framework to deal with them effectively in price action trading strategies, I created a course called Fractal Trading, Mastering Price Action and Beyond. This course will take your understanding of the candlestick to the absolute maximum, but that's not all. You will learn many other tools and techniques that will empower you to make high-quality trades as well as make more rational decisions in the markets. Here's a list of what you're going to find in this course. A solution to all of the problems and disadvantages associated with candlestick patterns. How to analyze any candle in any market in any time frame on command using a simple logic and without memorizing patterns. A simple and logical way of interpreting, understanding, and trading candlesticks. A much easier and smarter solution in comparison to the tedious and counterproductive memorization of candle patterns. How, when, and why certain price action elements alter the interpretation from candles, and how to use that in your strategy. All the necessary tools to extract the greatest possible amount of useful information from candles. Knowledge of several tools and techniques of price action analysis, such as phase analysis methods, different kinds of advanced lines and channels, different kinds of divergence, volume, advanced types of support and resistance, different kinds of reliable price action scenarios to trade, and more. A step-by-step process on how to find high-quality trades from blank chart up to trade entry, stop, and target. Several techniques on how to filter bad trade signals. Many powerful insights of risk management, trading psychology, and trading performance. Several highly detailed examples of the price action strategy in various challenging trading scenarios, plus tons of insights that can only be learned from years of practice. How to increase win rate as much as possible in a realistic way. How to minimize stop losses and maximize take profit targets. Many tricks and secrets of various tools of technical analysis and price action. How and when to use certain kinds of techniques to optimize results. How to trade with precision without losing perspective. How to deal with ambiguity in trading. The most powerful concept in trading technique, hyper-integration. How to trade with the benefit of multiple time frames without its pitfalls. Modified technical indicators to detect volatility and uncertainty in the market. Tools from chaos theory, fractal geometry, and game theory that will completely shift how you perceive the markets forever. The butterfly effect, integrated fractal candles, linear regression channels, and fractal manipulation patterns. Different kinds of objective trade entries. How to properly place logical stops in realistic targets in the most effective way. A price action strategy that allows you to apply advanced tools in a simple way. The multifaceted nature of risk-reward ratios, position sizing, and many powerful and non-obvious insights related to trading performance. The nuances of trading consistently versus trading sustainably. Misconceptions about developing a trading edge. Notion of how trading performance behaves in the short and long terms. How to measure performance objectively using the tools of institutional traders. All the tools you need to trade sustainably at a high level regardless of whether you trade your own capital or a prop firm account. By taking this course, you'll be miles ahead of most retail traders. Here are some of the highlights of the course. 41 video lessons in 5 modules. Over 5.5 hours of concise material. 180 practice questions. 751 slides of presentation. Certificate of completion. Logical and gradual course progression. Appropriate for traders in all levels. If you want to purchase the course, the link will be available in the video description. You can see the full table of contents in the link as well. If you have any questions, you can contact me at support@fractalflowpro.com. If you've made this far into the video, thank you very much for your time and attention. I hope I was able to add value to you in some way. If you like the course, please help support the channel by clicking the like button, subscribing to the channel, activating all notifications, leaving your feedback below, and sharing this video with your trading community. Thank you very much once again, and I hope to see you in the next videos. Take care.